Welcome back, everybody. In today's episode, we'll be discussing a topic that has been debated for decades. Which investing strategy is superior, dividend investing or growth investing? Understanding the difference between the two will help you decide which strategy is a better fit for your investing goals. So stick around. All right, so time for the portfolio update. For those of you who have been following, we're currently sitting at 442 and we've lost 2.6%. I said it in the last video, I'm not all that concerned with any losses at this point in time. For those of you who are new, these are our holdings. What we do here is we invest $10 a day into dividend growth stocks. So I made a quick PowerPoint for the video today and I want to get into that now. So I've heard a lot of talk on YouTube and social media about which is the better investing strategy. Is it dividend investing? Is it growth investing? Who knows, right? Everybody just wants to make the most amount of money the quickest way possible. Well, there's a big difference in these two, so I figured I'd make a PowerPoint just to show you the differences. So let's start off by defining the two, right? So dividend investing is when you're investing in a company that's going to pay you a regular dividend. So they're giving you part of their profit and paying you in the form of a dividend. An example of that would be Chevron. Chevron pays me a dividend. I buy their stock, they pay me. Growth investing is when you're investing in a company that you expect to experience growth. And it's not what somebody else thinks, what they think is great, but you have to think that that company is going to grow. An example of a growth company would be Amazon. They don't currently pay a dividend, so you would be looking at a growth investment there. So let's start off with dividend investing. So dividend investing, the number one reason is that it has reliable income. Okay, so they share their profits with the shareholders, and they do this even when the markets are down. That's why I love dividend investing. I know that even when the market's down, I'm still going to make money somewhere. So that's my first reason. The second reason is stability. So these companies that are providing dividends are usually well established and mature. They have predictable business models, right? So I know what Google is. I know what they do. They're always looking to expand. But a great company, a great example of a company that pays dividends, that's predictable and their business model's predictable and they're well established would be Costco. They pay me a dividend, you go to their warehouse, you buy a membership, and that's what it is. That's their business model. Number three is the reinvestment. So dividend reinvestment equals compounding. I take my dividends, I reinvest them in the company, and it compounds. So it's always adding money into my account no matter what. And even when the market's down, like I said, it's still adding money into my account. And number four is that it's more conservative. I consider it to be more conservative. I think there's less risk because there's a reliable income. With a growth stock, you're just waiting for it to grow. With a dividend stock, I'm at least getting paid a dividend that I know I'm having reliable income. So what I want to do now is I want to show you something cool that I found in M1 Finance. So something that I find to be pretty interesting with M1 Finance is that I can go here to edit, go over to add a slice, and right here where it says dividend yield, I can type in, let's say I want to look for a dividend that pays a minimum of a 2% yield and a maximum of a 6.5% yield. I can then reorganize, let's say 6.0. So if I say 6.0, I can organize it in the highest to lowest, and I can just scroll through all of these companies and really just do a little bit of due diligence into the companies, right? So I haven't seen any companies here that I know. I'll just keep going, and you could right here, HSBC, Dominion. You'll find all these companies. They give you a little bit of a tracker. It tells you how they're doing over the past year, 2 years. I think this is just a cool little feature they have on M1 Finance that I'm not sure they have on any other brokerage. I know they don't have it on the app on TD, but I thought this was cool. But let's get back to the growth. All right, so growth investing. The first thing you're looking for is capital appreciation. You want their earnings to grow because that's going to give you an uptick in the stock price, right? So the more money a company makes, the higher their stock price is likely to go. And that's going to be good for you. That's going to provide you your growth. That's something that you're always looking for. So your income, your revenue will be very important to you at this stage with growth investing. The next thing is high growth companies. You're always looking for high growth companies, hence growth investing. So where you're going to find that most likely is in the tech sector, biotech, renewable energy. Think about the companies that have absolutely blown up over the past, 10 to 20 years. They're in these sectors, right? There's a huge push on electric cars, on technology, social media. So these are the sectors that you're going to be looking towards. Long term, why do I have patience? Well, it takes patience because Rome wasn't built in a day. So if you're thinking that you're just going to jump in on a growth investment and it's going to happen in 6 months, it's going to happen in a year, well, you're sadly mistaken. A lot of people think that this company Palantir is just going to absolutely blow up overnight. They are incredibly wrong. And quite frankly, I don't see much with that stock, but that's for another show. The last thing is volatility. There's fluctuations, and you have to have a long and a short-term plan. Why do you need a long-term plan? Well, that ties back to the patience. It doesn't happen overnight. And you have to have a short-term plan as well. If this thing starts to really fluctuate and go up and down, how much are you willing to lose until it's time to sell and go to the next growth opportunity? Okay? So here we are with which one is best. And I always give people the same answer. It's up to you. You have to be able to you have to know what type of risk you're willing to take. I'm a dividend growth investor. I want to see constant income every month into my account that I can keep investing in and it'll compound. Okay? So something new on this show that I figured I'd do, just to leave everybody in happy spirits, is a little quote of the day. So this quote comes from Benjamin Franklin. It says, "Beware of little expenses. A small leak will sink a great ship." Right? So this goes back to what I've said in prior episodes. You go spend that money at Starbucks instead of investing your $10 a day, it's going to come back and bite you. You could have a great ship, a great portfolio, but you're spending money at Starbucks or Dunkin' Donuts or McDonald's. Well, if you spend it at McDonald's, it works in my favor, but guys, do yourself a favor, save your money, invest it. You'll thank yourself later. Thanks, guys.